For the second consecutive time, the Bank of Canada has announced a cut.
Today, the bank lowered the policy interest rate a further 25 basis points, bringing it to 2.25%.
That's Bank of Canada Governor Tiff Macklem at his most recent news conference.
This was our second straight cut and reflects ongoing weakness in the economy and contained inflationary pressures.
Scotiabank's chief economist, Jean-François Perrault, joins us this episode, as he always does, to make sense of this latest decision. He'll tell our Mina Ligaya what it might signal for the state of the economy, if and when the central bank might make further cuts, plus he'll give us a preview of what we might see in the upcoming federal budget, and more. I'm Stephen Maurice, and this is Perspectives. Now here's our Mina Ligaya.
JF, thanks as always for joining us.
Pleasure to be chatting.
So we're speaking around midday on Wednesday, October 29th. Earlier today, the Bank of Canada announced it was cutting its key policy rate by 25 basis points to 2.25%, the second straight cut. So JF, what does this tell us? What's the main takeaway here?
Well, the main takeaway, I think, is, I know, because the governor made it clear that this is the last cut that they are planning on doing, unless something deviates from the way they're thinking about the economy going forward. So they were pretty explicit. They're not usually that explicit, but they said if the economy works out as we anticipate, so slow growth, inflation controlled, not too much more damage from the tariffs, then this is the last cut. Of course, they'll remain on standby in case some things don't work out that way, and we'll do more if needed. But that's how to think about things.
And was that surprising that they signaled that so definitively and that everyone had expected that there would be a second cut, but the fact that they had signaled we're at the right level we should be for a while?
I mean, I think it's a pretty important signal. You know, the challenge for them, as has been the challenge for everybody else in the country, is how do you deal with inflation that's stubbornly elevated in the 2.5% to 3% range when you look at underlying measures of inflation against an economy that clearly needs support as we are dealing with the Trump tariffs and the uncertainty and all those kinds of things. They've cut 50 basis points since the last couple of meetings, and that's enough to just give the economy just a little bit of a boost, being mindful of the fact that inflation, even though it's expected to slow, might not slow. So it's just kind of this right balance. At least they think of it as the right balance between doing some things to help the economy adjust in the short run versus still being mindful of the fact that inflation is just a little bit too high to be comfortable with.
Let's talk about this particular decision and break that down a bit. What were the factors that drove this move to cut?
I think it's a recognition on the governor's part, the Bank of Canada's part, that the economy just needs a little bit of support, as we've indicated. Like, growth is not strong in Canada. There's no question about it. In the 1 to 1.5% range this year, maybe 1.5% range next year. So these are growth rates that normally would lead central banks to cut interest rates to try and provide a bit of stimulus to help manage the economic shock that's unfolding. As the governor's indicated many, many times, including in the press conference today, given the nature of the shocks that we're dealing with, like this trade shock, this supply chain shock, this transformation that needs to occur, there actually is very little the Bank of Canada can do to help the economy adjust to this new environment. It can help smooth the shock to some extent with a little bit lower interest rates, but really there isn't much that we can do or they can do to help diversify trade, to help increase investment, to help people feel more comfortable about the risks that they're dealing with. And that was, I think, the underlying thinking here, that the economy does need a little bit more support. They can't do all that much more because of these factors, while again, still be mindful of the fact that inflation is not quite at 2%, and there are risks that inflation going forward does not come down further than where it is now. So it's a bit of a balancing act, but on balance, paying a little bit more attention to the growth side of things than the inflation side of things because they did cut.
Mm-hmm. That's a good segue into my next question about the upcoming federal budget. Considering the Bank of Canada would have to make this decision not knowing what's in it, how does this upcoming budget factor into this decision and the subsequent one?
It's not clear. I mean, they will always say that they take into account fiscal plans by the provinces and the federal government when they are announced. Of course, we don't know what's going to be in the budget yet, so they can't incorporate that. But there have been a number of announcements made by the feds and the provincial governments in terms of what they're going to do on the infrastructure side and various spending measures. So that's reflected in their forecast. In fact, when you look at their forecast, they do expect the government side of the economy to contribute meaningfully to growth next year. So there's some of that in there. But clearly, there are going to be lots more, clearly, we don't know. There's an expectation that there are going to be a lot more things in the budget on November 4th, so next week, that are unknown. And those things are almost certainly going to be contributing to growth some form or another over the next couple of years. So I think if you think of it from the bank's perspective, their view now is that they will probably have a little more fiscal stimulus to deal with next year than are currently in the plans. And that may be at the margin one of the reasons they've said, listen, we're going to stop here and see if the economy evolves along the way we're thinking. If it turns out that the federal government does spend a lot and provides a lot of stimulus to the economy next year, maybe that changes how the Bank of Canada thinks about things in terms of where they go on interest rates. Like maybe they start to think about, well, maybe we need to raise interest rates later next year. It's surprising if the budget resulted in them saying that, but I think that's the kind of thing that's in the back of their minds. We think we've got the right setting for monetary policy now, knowing what we know about the fiscal side of things. But if the fiscal side of things changes or evolves in a very different way than what we think, then that will have implications how they think about the economy and rates and inflation.
Speaking of the upcoming budget, your team has put together an outlook for what to expect. What are some things we should be looking for? What's something we should highlight?
Yeah, there's a couple of things on the upcoming budget that we know and are hopeful about. The deficit will rise. Seems pretty clear they're signaling that. And that usually is a cause for concern because, of course, the more the budget rises, the more interest costs there are, the higher tax revenues need to be. But, there is an argument to be made that if you're going to do budget deficit, now is the time, given this kind of structural transformation the economy is going through. So we're going to look to, obviously, what the number is, 70, 80, 90, 100 billion. We'll see. But more importantly, from our perspective, is what that money is used for. This is going to be Prime Minister Carney's coming out party in some sense. This is the big bang in terms of what he's trying to achieve. So we'll be much more interested in what is in the budget, where that money is going from. How are they going to stimulate private sector investment? How much of this is going to facilitate or help the transformation that he keeps talking about? And of course, what impacts will that have on growth? So in contrast to previous budgets where we'd be a little bit more focused on this deficit is high and we're worried about it, we're going in thinking deficit is going to be high and much more interested about how transformational will this actually be.
Mm-hmm. So what does the outlook laid out today mean for Canadians? On one hand, it's kind of good news if you're a borrower looking to pay a bit less, but then there's also these signals of a weakening in the economy ahead.
For borrowers, I think the message is pretty clear from the Bank of Canada's part. So don't expect more cuts. There might be more cuts, but don't expect them. So, if you're thinking about borrowing, if you're thinking about taking a mortgage or buying some property or making an investment, assume that the rates that are in place now are likely going to be the rates that are in place for a while at the short end of the curve, from the Bank of Canada's perspective. And that's an important message because as central banks cut interest rates, people naturally think, well, there's going to be more cuts to come. So maybe I will wait a little bit because it'll be cheaper if I wait for the next decision or 6 months from now. And the governor's saying, don't count on that. It might happen, but don't count on it. So that, I think, is a pretty good signal for people that are in the market to borrow money to finance things that now is probably as good a time as ever as there is going to be to borrow from a rate perspective. But he's also signaling that further up what we call the yield curve, so longer term borrowing costs. Now, if the Bank of Canada is not expected to move a whole lot, then longer term borrowing costs, say 5-year borrowing costs, 3-year borrowing costs, 10-year borrowing costs, aren't going to expect significant moves by the central bank either. And as a result of that, you can think that maybe those borrowing costs as well don't change very much from where they are here. We've got them drifting up gradually over the next year or so, but not a meaningful change from relative to where they are now. So it's a message of, I think, relative rate stability. And that, I think, is helpful in terms of helping people make some informed decisions about what they're going to do on the borrowing side of things. It provides a little bit of certainty, a little bit of clarity that you don't necessarily have to wait 6 months or a year to get lower financing costs. If you go now, that's probably as good as it's going to get.
One big borrowing decision is buying a home. And I'm wondering if you could walk us a little bit through where is the state of the housing market in Canada now that borrowers know, okay, we're not waiting for more cuts for a lower price or a lower rate.
It's clear this is positive for the housing market. Now, it's not hugely positive because, we're not talking about 100 basis points lower interest rates, but 50 basis points is 50 basis points, and that's meaningful to a lot of borrowers. So at the margin, it helps give a little bit of clarity to where the housing market might go, makes it a little bit easier for people to make that decision. I'm going to buy now, I'm going to upgrade. So there's a positive element there. Now, of course, the background to all of this is the Bank of Canada is cutting because the economy is not strong. And, people are worried about things. They're worried about losing their jobs. Job market's not particularly strong, especially for the younger folks where it's just downright hard. You can think of rate cuts as good news because it does help on the financing side of things. But if rates are being cut because the economy is weak, it's not clear on balance where things come out from a buyer perspective. But, it should mean that the housing market will be a little bit better as a result of this. And we've seen actually a fair amount of momentum in the housing market across the country the last several months, where on the resale side, things have been generally improving across most markets, not everywhere, but most markets, some obviously better than others. And this at the margin gives a little bit more of a oomph to those who are in the market for buying things. So good news, but it's, there's a broader context here in which you've got to think about how to interpret this rate increase from a buying perspective.
I wanted to go back to something that Governor Macklem said during his press conference, or actually in the statement as well, that the weakness that we're seeing in the Canadian economy is more than a cyclical downturn. It's a structural transition. And this was emphasized quite a bit during the press conference. Could you help break down for our listeners, what does that mean? What is he signaling?
So there's a few things that are going on. Obviously, the Trump-related trade disruption, right? So is our access to the U.S. going to be lower than it was historically? Probably. Do Canadian businesses have to think about opportunities differently with respect to the U.S.? Probably. Do we have to diversify our supply chains? Certainly. Are global supply chains going to get rearranged? Definitely. So these are things that are complicated and complex and take a long time. Like, how do businesses rethink their business plans? There's business strategies. So that's a structural feature of what's going on now. Like, you're rewiring parts of the global economy. You're rewiring how businesses do things. That's big changes. And that's true of American businesses, it's true of Canadian businesses, it's true of businesses around the world. You also have to have at the same time an additional layer in Canada and other countries around the world where, because the Americans have been so important to us as an economy, as a market, we need to think about a world in which we have to diversify our exports to some extent away from the US. And that's another structural change. How do businesses make contacts in other countries? How do you develop the port infrastructure, the transportation infrastructure to send more stuff east-west as opposed to north-south? Another structural change. And then you have a structural change related to, and this has got nothing to do with President Trump, another structural change with respect to population growth, which has been extremely strong in the last number of years. I mean, we've been talking about this forever. And we're in a world now where population growth is slowing rapidly because, of course, the government has instituted some changes that result in slower population growth. And with slower population growth comes things like, well, you have weaker consumption growth because, of course, if you have less new people in the country buying stuff, that necessarily is a headwind for the economy. And that's a structural factor, right? This is a thing that it's not a matter of interest rates. It's not a matter of fiscal policy. It's not a matter of people feeling good or bad about the economy and impacting their spending decisions. This is a matter of one of the key inputs into an economy, population, is growing at a less rapid pace, significantly less rapid pace. So you have slower growth that results from that. You might still have higher GDP per capita growth. You might still have consumption per capita rising, but smaller increase in population means that your economy is probably going to grow at a slower pace than it has historically. And that's another thing the governor featured in his press conference today.
So fundamental changes in just the way the Canadian economy will work with different trading partners, slowing population, and looking to the budget to sort of support those structural changes. And there's only so much that the Bank of Canada can do in terms of supporting that with monetary policy.
Exactly. And I think Deputy Governor Rogers made the point during her press conference as well that in terms of what the Bank of Canada can do, obviously lowering rates a little bit to help facilitate the adjustment. But another thing the Bank of Canada can do, which is actually key to how the Bank of Canada impacts the economy, is to ensure people have faith in the inflation target. That people don't worry about inflation being too high going forward, being too low. Control the things you control, and taking away inflation risk is a really valuable impact of Bank of Canada decision-making process, even though we typically don't think of it that way. We think about interest rates being higher or lower. But eliminating that risk or controlling that risk, it's pretty meaningful in an environment where people are worried about tariffs and what it means for inflation and the cost of living going forward.
So where do we go from here? How much of an impact can a second straight interest rate cut have? And what should we be watching for in terms of signals for how the economy is progressing, where the economy is going, but also next year's Bank of Canada decisions?
I mean, there's a range of things. Obviously, the fundamental challenge the Bank of Canada has been dealing with and will continue to deal with is pressure on inflation versus the pressure on the growth side, and which wins in some sense. We still are worried that there might be some inflationary pressures to come. And if that happens, then it could very well be that the Bank of Canada may need to raise interest rates sometime next year. So we'll be very watchful for that. They will, of course, as well, given that their job is to target inflation. We have to look to what's going to be in the budget and how transformational or not that's going to be. How quickly will it have an impact on the economy or not? And that will be, I think, an extremely important thing to consider and track as next year progresses. What is the impact of these policies? Are they working? Is investment rising? Are people feeling better? That's a big unknown. Depends, of course, partly on what's in the budget, but how people react to that. We don't know right now. And of course, you can't get away from the fact that whatever happens on the US policy side is very meaningful to us. And that is an environment where there is always, well, sorry, not always, there has been, since President Trump's been in power, a tremendous amount of volatility on the policy side. And that will undoubtedly impact us for good or bad, depending on what actually happens. Do we get a trade deal or not? Are there better relationships with the Americans or not? That could have a meaningful impact on how Canadians decide to engage with the economy, how businesses think about investment, how they think about hiring. So those are three really, really important things that we'll be tracking. Of course, in addition to, employment and the various things that typically economists focus on, there's just right now these really big things that you layer in on top of what economists normally do to try and figure out where growth is, which is largely policy decisions.
So, Jeff, in your view, what are the main takeaways for Canadians from today's decision?
There's a few. The good news is obviously that they've cut interest rates a little bit, and that will provide some support for Canadians going forward. But very importantly, the governor made it pretty clear this time around that they are signaling to us that they think they're done cutting interest rates. And that's an important signal for households because typically when you cut interest rates, there's an expectation that you're going to cut a little bit more. So maybe you can wait a little bit longer to borrow stuff because it'll be cheaper. The governor's going out of his way to tell us, don't count on that. Effectively, if you're going to want to buy something on credit, now's as good a time as ever is going to be. So that's, I think, an important thing. The second element is they're cutting interest rates despite the fact that inflation is high because they're worried about growth. Growth is weak. There's no question about that. So, we can think of the good side of lower interest rates. They lower the cost of financing, but this is occurring because the economy needs some support. So there is weakness there. And that is weakness that will extend into 2026. No question about that. Thirdly, the governor's trying to instill some degree of confidence in Canadians with respect to inflation. That is their job, inflation targeting central banks. There are worries in Canada about inflation dynamics. Households expect significant inflation next year. To the extent that the governor can provide some degree of confidence that inflation will, in fact, go down next year, hopefully hit their target. We're a little bit cautious about that, but certainly they think that, or they argue that he's taking some risk off the table for Canadians. Says, don't worry about inflation. We got it under control. Worry about other stuff. And I think that's a pretty powerful message, too.
Thanks again, JF, for coming on the show to break it all down for us.
Pleasure to be on with you.
I've been speaking with Jean-François Perrault, the chief economist at Scotiabank. The Perspectives podcast is made by me, Armina Lagaya, Stephen Maurice, and our producer, Andrew Norton. The clip you heard in the intro was from the Bank of Canada. For a transcript of this episode, as well as other stories, insights, analysis, and thought leadership, visit our website, scotiabank.com/perspectives. We'll see you next time.